Welcome to County Portal, your simple source for local government services and public records. Let's get started.
Ever looked at your paycheck and wondered where a big chunk of your money went before it ever hit your bank account? A major part of that is federal income tax withholding, and understanding how it's calculated is key to managing your finances. It all starts with a form you fill out when you start a new job, the Form W-4, the Employee's Withholding Certificate. This form is essentially an instruction manual you give to your employer. It tells their payroll system exactly how much money to set aside from each of your paychecks to send to the IRS on your behalf. The goal is to get this number as accurate as possible so you don't owe a huge bill at tax time, nor do you give the government a massive interest-free loan all year only to get it back as a refund. The calculation itself is based on two main things: how much you earn and the information you provide on that W-4. The first and most important piece of information is your filing status. Are you single, married, filing jointly, or head of household? This determines the size of your standard deduction and the tax brackets your income will fall into, which is the foundation of the entire calculation. Next, the W-4 asks about multiple jobs or if your spouse also works. This is a critical step because if your household has more than one income stream and you don't account for it, each job's payroll system will think you're earning less than you actually are, leading to underwithholding and a potential tax bill. Step 3 is where you claim dependents. For each qualifying child or other dependent you have, you get a tax credit. By listing them here, you're telling your employer to reduce the amount of tax withheld, which means more take-home pay in each check. Finally, there's a section for other adjustments. This is where you can fine-tune your withholding. You can add other income you expect to receive that won't have taxes withheld, like from investments, which would increase your withholding. Conversely, you can account for deductions you plan to take, like for mortgage interest or student loan interest, which would decrease your withholding. There's even a line where you can simply request a specific extra dollar amount to be withheld from each check, a useful tool for those with side hustles. Once your employer has your W-4, their payroll software does the math every pay period. It takes your gross pay for that period, annualizes it to estimate your yearly income, subtracts the appropriate standard deduction and any other deductions you noted, and then calculates the estimated annual tax based on the official IRS tax brackets. Finally, it divides that annual tax amount by the number of pay periods in the year to arrive at the exact amount to withhold from your current paycheck. This whole process is designed to make sure you're paying your taxes gradually throughout the year instead of all at once. Thanks so much for watching. If this video helped you understand your paycheck a little better, please hit the like button. For more simple explanations